Good afternoon, everybody, and welcome to this edition of our weekly market analysis session for Monday, 30 Jan. My name is Carl Capolingua. I'm the market analyst over here at ThinkMarkets Australia, and it is a pleasure to be with you as we delve into all the key market-moving events from last week and have a look to the week ahead. Let's kick off with crypto first. It was a solid week, got better on the weekend. So these are Saturday to Saturday moves. Sunday was a nice move up as well, as we'll see in the charts. But as you can see, Avalanche up 25%, continuing to bask in that warm afterglow of being anointed by Amazon's AWS, its key cloud computing division, to be the first blockchain officially to be chosen for developers to be able to create Avalanche nodes and start to experiment with blockchain smart contract technology. Up now 100% for the month, but you can see if you're looking at a year-on-year basis, down 71%. And that is the theme here. In that far right column, still heavy falls experienced by almost all of those cryptos. Just Tron is the only one up there on a year-on-year basis. But monthly gains starting to build nicely there for Binance Coin, Cardano, even the majors, Bitcoin and Ethereum. Week on week, though, Ethereum looks like it did miss out a little bit there, but not by much. Cardano and Polkadot probably the best. In terms of fear and greed index, back to 55, edging towards greed. Haven't seen that for a while. It was 28 only last month, mired in fear. Has crypto winter ended? I think there's a very good chance it has. I think we're in the very early stages of a new crypto spring. Bitcoin, as we can see on screen, the OG crypto, as it were, pushing through that 20,000 initially, that key handle, helped by a decline in the US dollar, obviously Bitcoin priced versus the US dollar, and an overall decline in long-term yields. So long story short, those lower yields facilitate risk-taking behavior, and that is what crypto, whether you're a fan or not, what crypto depends on. I think that AWS Avalanche news also helps significantly. I think that just puts crypto in a different sphere now of solving real-world problems of mainstream adoption as well. So a few factors there, turning Bitcoin out of the teens and into the 20s. 25, I think, is the key level from here, 25,208. Close above that. I think we're going to see quite a bit of FOMO. It's going to make some headlines. And it's going to have a lot of money that was sitting on the sidelines wondering if they should get into crypto, thinking maybe it's time to get into crypto. So let's see it close above that. 27,878, potentially a target from there, but we could see three handles with 32,385, probably the ultimate target. I haven't really talked about downside protection here because I think it is those short-term trends. You can see the light green zone, long-term trend has gone through the traffic light system from dark pink to orange. Those things are changing. But let's say below 2384, I think something is very wrong with my original thesis. Having a look at Ethereum, pretty similar in terms of short-term trends are turning. Long-term trends have gone to amber through the traffic light system. We're hovering, we're holding above that trend zone. I think that's the other key. Just flick back to Bitcoin. You can see we're no longer being impeded by that long-term trend zone. We're actually being helped by it. And I think that's more evidence here on Ethereum. Maybe the uptrend is not as strong on Ethereum in the recent passes in the last few weeks, but I do think it is improving. Close above 1680, I think, quite bullish. Close above 1790, very bullish, and ultimately the 2031 key level there is similar to that 25,208 on Bitcoin. Otherwise, to the downside, look, I certainly would want to see a print back in the 1400s. I think that would suggest that something is wrong with my thesis. Let's switch gears now, head over to equities, looking around the region there. Nikkei had a good week, up 3%. These are good moves. Hang Seng up 5%. Not a misprint on the Shanghai Composite. It was closed, obviously, for Chinese Lunar New Year holidays. The big driver there, the NASDAQ, I've talked about this idea that when rates come off, US dollar backs off, it can help risk-taking activities, and the NASDAQ is the poster child for risk-taking in the US. in terms of stock. So the 4% gain there is important, and just as important as the fact that the Dow Jones missed out somewhat with a 1.8% gain. Obviously the S&P 500 has a bit of a mix of the value stocks in the Dow, those big blue chip stocks that the fund managers, who, let's face it, have to invest every day, that pension money keeps rolling in, they tend to head to those really defensive liquid blue chips in times of uncertainty and avoid like the plague those high growth NASDAQ and Russell 2000 stocks we'll look at in a sec. The Russells turned up, the NASDAQ's turned up, and value is just being impeded. It's telling you that fund managers are starting to take risks again, look flat to up in Europe, but maybe lagging a bit. Let's have a look at the S&P 500, the benchmark index in the US. We can see through the traffic light system on the long-term trend, gone to amber again. So we're seeing an improvement there. The short-term trend has swung to the upside. We are seeing higher peaks and troughs in the price action. And I think we're starting to see those white candles really starting to figure as well. Certainly starting to outpace any impacts from the black candles. This last swing low there at 37.64, I like the fact that we're starting this current run to push through that long-term trend zone at a much higher level, certainly compared to that 34.91. You look at that rally from 34.91 into 41.01 and how it failed, and I guess it had a really good push from there, similar to that 36.36 to 43.26. Well, my point is we're starting this push from a much higher level, and therefore I think it gives us a better ability to actually get through. 43.26 is going to be, I think, the ultimate target, but we do want to see a good performance around 41.01. That's a pressure zone. The black candles in there, the long upper shadows in there would be disturbing, especially in a week where we're going to get a Fed meeting and non-farm payrolls as well. So that's a key pressure point to watch this week. To the downside, looking for support levels. Look, I think you can stay long as a 39.50 holds, and then I think we're in big trouble if we're getting below, say, 38.77 to 38.85. Looking at the NASDAQ now, very different because we haven't transitioned through that traffic light system into that amber zone where we can start to think about, increasing our long side exposure. And we can see why, you don't want to jump too quickly, because look at this last time we tested it up there at 13.181, and we bounced down off it very quickly. It'll be all about the candles from here in the short term. Do we print more whites? Do we print lower shadows, indicating that demand is still very strong? We know price action is back to up. High peaks, high troughs, plenty of white candles in this last run, probably 3-1 compared to the black ones. If those black candles come in, if those upper shadows come in around here, literally around here into 12,000, it could spell a bit of a problem, especially if it starts to coincide with what the Fed does next week. So signs are improving. There are signs that the trends are improving, the overall sentiment is improving, risk-taking behaviour is improving, but we are far from out of the woods yet. Where would that point be? 13.181, close above that. We're officially in a new bull market in the US. Russell 2000, we've talked a lot about these big blue chip defensive stocks. This is the 2000 much smaller stocks in the US as collated by Russell. And again, similar to the NASDAQ, where it is pushing from a higher base at 1722 to get through those overhead resistance levels. But unlike the NASDAQ, it has actually started to transition to a long-term uptrend potentially through that amber zone through here. Short-term trend very good, price action fine, and the candle's looking pretty good. Above 1965, very interesting. Above 2030, again, we're in bull market sort of stuff. Okay, let's head over to the metals now. So I know copper very popular at the moment. High-grade copper is a very popular contract on the ThinkMarkets platform, and I know a lot of listeners will be holding copper stocks in their portfolio. And I do say the best way to play copper is not by buying a copper stock, it is by buying copper itself, and you can do that with us through that high-grade copper contract. And the reason for that is, a copper mining company is an ongoing concern. They have, they've got costs. They need to make sure those costs are lower than their revenues. They have production schedules which can be interrupted by natural disasters, and they might have hedging in place so that if there is a rise in the underlying commodity, it means nothing to them in terms of their profit. So I think you need to be a little bit smarter about this old reflex of, commodities going up, I need to find commodity stocks. I don't think that's always the smartest way to play it. Anyway, it was down last week, by the way, but not by much. We'll have a look at that chart in a second. Improving, well, everything else, in particular tin and lead, but otherwise not too bad. Platinum down a little, silver down a little, as the gold story started to cool somewhat, but we've got charts coming. Iron ore was up a touch in the Singapore-based US dollar price, because it continued to trade last week, albeit very, very low volumes. The Shanghai contract is closed for obvious reasons. There's that pullback in copper. It was an media spot last week, and I said, hey, it's looking a bit tired here. I mean, not end of the run sort of stuff, but in need of a bit of a pullback sort of stuff, a little bit of a shaking out of some of the weak hands. And I think that's what we started to see on Friday. But even then, you can look at that lower shadow in that last candle. There's still a bit of cheeky demand in the system there. So this level here, this sort of 410 to down to that round number, I think is where it could pull back to. Watch for the lower shadows in here. Any white candles in here as well could be very interesting to give you that ability to buy a pullback in what I think is going to be quite a nice developing trend here. 458 still going to be resistance to the upside. Look, if you're bullish on the copper story, I think you can maintain that position until we get below, well, we wouldn't want to print below, say, 393 again. Nickel, not as strong, but starting to improve. That's somewhat encouraging because it is obviously a key component in steel production. Steel production is all about global growth. We haven't looked at lithium for a little while, so let's have a quick look at the two key lithium contracts. As we know, lithium stocks on the ASX pulled back sharply and have had a rally over the last week and a bit. The pullback was largely to do with a bit of a decline. And I say a bit, because when we see this in the next chart, a modest decline compared to the huge rally it's had in some of these underlying lithium minerals prices. So lithium carbonate, your Allchem is one that's very dependent potentially on this price because they produce lithium from lithium brine. So you've got huge salt lakes in Argentina that they evaporate and scrape up the crystals, put them in bags and send them over to China, and that's the price here. Pull back from nearly 600,000 yuan per tonne into sort of 450. Then you've got your lithium hydroxide, which you can actually get from lithium carbonate if you process it. Otherwise, you could be getting it from your spodumene, which is your hard rock lithium deposits that, for example, Pilbara Minerals is producing. Has pulled back a little bit, but nowhere near as much, 85 to 80, and probably represents the premium that lithium hydroxide commands due to the fact it is closer to a precursor for your EV battery manufacturers. The bottom line there is I think there's nothing really to panic about in terms of lithium prices at this stage. Gold, I don't think you need to panic here either. I still think the short-term trend is very, very strong. I think the long-term trend has swung to up, so that's all hunky-dory. We are seeing some supply come in. Obviously, Thursday there was quite a significant supply candle. Wasn't really backed up on Friday, so taking some heart from that. We are seeing a bunch of lower shadows in the system. Again, I think it's fatigue more than exhaustion in terms of where this trend can go. I still think we could see a two-handle in the not-too-distant future, but maybe not before we see a slightly more meaningful pullback into the 1900s. So stay the course. If you've got a longer-term view, if you're trading it, you could take some profits here and look to buy back around 1900. We probably wouldn't want to see it get below 1865. That would suggest that the short-term trend is starting to change. I must admit I've made an error. I haven't updated this chart. It's missing a week's worth of price data, but to be fair, it didn't do a whole lot last week. It's still hovering beneath that sort of 82.50 level. And look, I'm a little bit undecided as to which way to call this one. Look, the long-term trend is down, but it is starting to change in the short term. I just don't think you need to get too interested in it until it's trading, I'm going to say, above 85. If it was to start to trade back below 73.40, then that long-term trend is reinforcing itself. For what it's worth, it was down nearly 3% for the week. That's the West Texas crude contract on screen. Brent was down at 1.5. Natural gas continues to fall. We'll look at that chart in a second. Just noting the Aussie dollar did have a very good week, as more broadly speaking, the US dollar pulled back, albeit quite slightly. And then bond yields in Australia quite sharply higher, but more modestly in the US higher as well. This is coking coals heading to some of the energy contracts now. Look, not really an energy contract per se, because we tend to think of this more as one of those industrial metals focused contracts, because you put your coal with your iron ore together, and that's giving you steel. So this is very much a global construction story, a China property story here. We can see it continues to improve in line with that iron ore price, which was a couple of slides ago still looking very good. If we do look at the thermal coal side of things and the energy production side of things, we can see some substantial weakness creeping into some of these contracts. For example, Newcastle coal breaking below that 289 level, breaking below that sort of 3 handle, and really looking like this long-term trend, for all intents and purposes, has switched to the downside. Will it be a precipitous fall? Will it be sort of a slow, steady grind lower? It's edging towards more the precipitous side of things, to be honest. We'll look at natural gas in a second. You see how quickly that came off. So definitely sounded the alarm here on some of your thermal coal producers, so your Whitehavens, your New Hopes, your Terracoms, and your Yancoals. You might want to go review some of the trends on those charts. Talking about precipitous falls, you can see just how quickly things turned around for natural gas futures in Europe, and that was because up until very recently, we've had somewhat warmer temperatures than were expected, and many of those countries did build up their stockpiles quite well in advance of expected shortages. And then this is the natural gas contract in the US also heading south very quickly. So it's a big drop. You look at over 10 there, down to below 3. We're back at some pretty key levels historically. So you can see there's a big low there from April 2021. The May one's not as important, but that's a big one there at April 2021. So for the bottom feeders out there, if you're really, really brave, you might want to start to add some risk here. You'd be, I think, foolish to fight the trend and take a big position, but you might want to take a tiny, tiny, tiny nibble here and then start to add to that if the trade starts to turn around with a stop loss somewhere beneath maybe 240, for example, if that thesis were to play out. Have a look at the US dollar. Obviously, we talked about at the start how it has facilitated a rally in cryptocurrency, but also those commodities as well. It does help the pricing there. Had a pretty flat week overall. A couple of white candles there on Thursday, but for the most part, trending lower. Having a look at the Australian dollar, obviously inversely related to that last picture, it had a pretty good week for other reasons, mainly due to that CPI. We'll talk about that in a second, but the trend still looks very strong here. I don't think if you're long the Aussie dollar, I don't think you need to change that thesis. If there is a pullback, 70.63 to 70, I think will be very good support. You'll probably see a bunch of lower shadows pop in there, and if you do, I think you can add to your long position down there. I don't think you need to rush in if you're not long at this stage, because I think 71.36, I still think there's some influence from that high. And then, I think 72.82 is probably going to cap. So from a reward to risk perspective, shorter term traders might be left wanting on that trade. But looking longer term, there's nothing really so sinister in the chart that can't suggest we couldn't see a 75 handle or even a 76.61. So it's probably more of a hold it if you've got it and wait for that pullback maybe into a 70 to give you a better risk reward if you don't. I should say, look, where does the thesis go wrong? Where does this idea that this uptrend is in place go wrong? I don't think you want to see it print below 68, 69. Having a look at Australian yields, they did push higher during the week on the worse than expected CPI data, but they're really quite flat, I think, overall. And I think that's the message from this chart is that in terms of long-term rates, we've probably seen the peak for the time being. And I think that's being reflected here in the US 2s and in the US 10s as well. I think we can say that the path of rates in the future probably will not be substantially high. And I know I've really used some language there that's totally hedged my bets, but that is how unpredictable things are probably going to be in 2023. But I think we've seen the peak there at 434 on the US 10. Obviously, the Fed's probably going to raise rates by 25 basis points this week. I don't think the market's expecting 50, so that would be a negative shock. And I don't think the market is expecting no increase. That would be a major positive shock. In terms of the yield curve, look at the orange one, it's the current one. Obviously, we're just seeing how it's changing over time. It is getting steeper, and that's reflecting some of the weaker US data we've seen, which is more indicative of a potential recession ahead. Just a reminder that inverted yield curves are usually a precursor for recessions in the US. Having a look at some of the data out during the week, US GDP, so US economy-wide growth up 2.9% in the December quarter and compared to the September quarter. Looking at the calendar year, GDP was up 1%, and that is down from the 5% increase in 2021. So 2022's gain, 1%. And that was well down from 5% in 2021. The 2.9% quarter-on-quarter number was slightly higher than analysts expected. They were looking for 2.6%, but lower than September's equivalent 3.2%. So you can see US economy is slowing down, and just even in the chart there, all of these larger green bars compared to these two pops here as the Fed started to increase interest rates. That's what those two negative quarters represent, and then somewhat of a bounce back from there. The key will be where it's going from here. GDP notoriously backward looking, and most analysts still expecting we're going to see a couple of red ones coming up some stage in 2023. I think the key to that GDP data is consumer spending was up 2.1%, which you would normally say is quite healthy, but when you adjust for inflation, it was basically flat. So that is disturbing. Inflation is still really undermining growth at this point in time. Durable goods orders, always important because, they're very forward-looking. A durable good is something that generally, big ticket item, costs a lot of money, lasts a long time. You really think about it before you invest. That was better than last time, up 0.4% compared to the 0.2% fall, but not as good as expected. They're expecting 0.3%. That equated to a 5.6% annual gain. If you took out defence orders, it was actually a little bit better, up 6.3%. So that was actually a fairly good reading on the US economy there. Heading over to the PCE price index, actually on the right, I'll talk about the data on the left in a second. This is the Fed's preferred measure of inflation. We saw a 0.3% print there on the core. The headline was only up 0.1%. for a 5% gain, and the core, as I said, 0.3% for a 4.4% gain, and that is a slowing from November's 4.7% gain. And we are seeing quite clearly in the chart that we appear to be over that hump in terms of inflation, but at 4.4%, we're still way above the Fed's target 2%. But the Fed, they're not silly. They know that the interest rates they put into the system take some time. There's a lagged effect for them to bear out. Goods inflation was 4.6% per annum. That was well down from 6.1% in November. So it's showing Americans are spending much less on goods, but starting to pick up on their spending on services. So we're seeing a bit of a switch there. Services inflation at 5.2%, so much higher, but that was flat with the previous month. Looking at personal spending, just very quickly here, spending was down. Yes, it is 0.2%. That's the one at the top. Expenditures and incomes were up slightly. Incomes in line with expectations and spending slightly worse. So that spending number will be a bit of a concern because it shows weaker economic growth. Having a look locally here at NAB Business Confidence Survey, we saw confidence improve, but conditions deteriorate. So that's not so bad because confidence is about what's coming down the track. We did see trading, profitability, employment, forward orders, capacity utilization, and sub-indices all lower. Price pressures were easing, however, and that's probably helping confidence. Labor down, purchasing costs down, and therefore facilitating lower final costs as well. But the trend here I don't think is great. You can see throughout the course of 2022 getting worse and worse on business confidence locally. And the trend here is not good either because it's bottom left, top right, isn't it? Consumer Price Index, that's the local inflation gauge. It is released quarterly. So the December quarter headline inflation up 1.9%. That was slightly faster than the 1.8% in the September quarter. If we look at it on an annualized basis, it was 7.8%, which was hotter again than the 7.6%. Now, the Reserve Bank over here in Australia, they typically don't use the headline, much like the Fed doesn't use the headline either. They're using core numbers, so we're stripping out volatile components like food and energy. The trimmed mean for the December quarter was 1.7%, a little bit cooler, obviously, than the headline, but hotter than September's reading. And if we look at the annual reading, this is really what markets didn't like, the 6.9% per annum print, way up from September 6.1% and miles up from the Reserve Bank's 2 to 3% target zone. If you look at the monthly series, and this is still very new, so we're taking this with a pinch of salt, monthly inflation to December was 8.4%, and that was way up from November's 7.7%. So you couldn't really get a hotter result than that. And I do believe we are seeing some of these second round impacts of inflation in the Australian economy. So inflation that is causing more inflation, which then causes more inflation. And that's what the Reserve Bank will no doubt be worried about. Maybe if we start pulling back on our holiday spend, that would help. That was up 13.3%, and that is a major discretionary element. What isn't discretionary and what is more concerning is the fact that housing was up 10.7%, so we're looking at rents largely there, and electricity up 8.6%. That's stuff you can't usually do without. And approximately 9 out of 10, here's the stat for you, almost 90% of the 87 component basket of goods and services in the CPI are now greater, or their rates of inflation now greater, midpoint of the Reserve Bank's target range. So we've gone from markets being somewhat divided about whether the Reserve Bank would need to increase interest rates at its next meeting on Feb 7 by 25 basis point. It was kind of a 40, not 64, swinging to decisively that they will increase interest rates by 25 basis points. And some analysts now factoring in the potential for a 50 basis point hike, or at the very least, instead of getting just the 2 more 25 basis points hikes, we're going to getting a bit more than that. So we saw the terminal RBA rate moving up from about 3.57% to 3.74% after that CPI data, and that's an increase of 17 basis points. Effectively, the market just increased rates by 17 basis points last week without the Reserve Bank actually doing anything. How did that impact the Aussie market? You see, not at all. I mean, that black candle is one of the few in this huge run we've had from 69.05. Incidentally, that's the first trading session of the year, the black one. The white one's the second, and then we've gone up from there. That was the CPI data there. We saw a small pullback, if only for a second. And when you have huge runs, bad news, or seemingly bad news, and no pullback, it just speaks to the immense wall of demand that remains in the system and the total lack of supply. We are in a supply vacuum here on the Aussie market. Sellers do not want to sell, and they probably won't sell until they get much higher prices, potentially even new highs. The demand is sitting there. It's rock solid. It's not pulling back, saying, you know what, I'm only going to come in at lower prices, just sitting there, soaking up stock, waiting for the stock that is here to evaporate, and then they will have to pay higher prices. A little bit of a mixed bag there in the sectors. Energy down, we know why. All prices were down. Gold pulled back, we know that. Healthcare, defensive. Telecoms, also quite defensive. When defensive sectors pull back and risk-on sectors go, like technology, discretionary, resources, property even, you know that's a good sign. So everything looks pretty strong there. Where does the thesis change? Look, I don't think we want to see this trade below 73.76. I think supply has come into the market, but otherwise it's onwards and upwards from there. Reflecting my change, I mean, the last time I spoke to you was back in December, and I was pretty bearish back then, looking at a lot of the charts we had to deal with, swinging far more bullish today than I was then, looking at market breadth indicators. So how many stocks in the ASX 300, so going broader than the 200, are trading above their respective moving averages. And you can see here we are in bull market conditions. That's the green zone, where you've got 2/3 to basically 70% of stocks above those respective moving averages. So really anything from 1 month out to 3 months. And then even if you go out to sort of the 1 year trends, so looking at my trend ribbons, those longer term trend ribbons, you've got now over half of the stocks trading above those. And you need to trade above those to change your long term trends. So that's starting to look very, very strong as well. Also reflected in the sector trends here. So I say stick to the double greens, but there's far more of them now than we looked at last time. And reflecting that market breadth concept of more than half of the stocks now trading above their long-term averages. You can see it's really only tech that's still got that long-term downtrend. Otherwise, we're at neutral at least. I do like discretionary. I know that's only neutral on the long-term uptrend, but I think the chart is turning there. I like staples. Again, I think that chart is long-term trend is potentially turning up. And then you still can't doubt the strength in materials. You've got to stick with that. Energy, I'm not as confident on, but I don't think it looks terrible in financials. Again, invincible banks at this stage. Having a look at where the value lies in the Aussie market. Well, overall, we're at 14.6. That's still technically cheaper than the long-term average at 15.7. This is 1 year forward PEs, as put to Thomson Reuters, where the data comes from by the biggest brokers. Certainly way down from its peak post-COVID of 20.1, but up from the start of 2023 at 13.6. So things are getting more expensive. Yes, prices have gone up, but they've gone up at a faster rate than earnings are expected to rise. So keep that in mind. Cheap sectors. Well, we talked about tech maybe turning around. It's starting to, it was starting to look cheap at 24.9, well below its long-term average. You might say, 26 isn't cheap. Well, it's cheap for tech, and it's way down from that 77 high. Property, I think, still looking very cheap there, 15.6 versus 16.3, and somewhat off its lows there at 14.4. Utilities probably on the right side of cheap, and then they tend to fall away from there. Telecoms looking quite expensive. Healthcare looking substantially expensive, I would suggest. Okay, looking at the upcoming data for this week, pretty quiet actually in Australia. I'm not even going to mention any of those because I don't think they're going to move the market at all, but there's plenty of market moving stuff here for overseas. Looking, starting with China, we've got some data coming back after their holidays. So manufacturing and non-manufacturing PMIs, they're the official numbers there, and then we'll get some unofficial data from Casein during the week. We've got the Conference Board Consumer Confidence Survey coming out the US on Wednesday morning, our time, after the Chicago PMI. We're going to get some GDP estimates in Europe. Then we start to get some CPI data, flash CPI data for Europe. That will be important if you're trading currencies like the euro. Non-farm employment change from ADP, that's a private sector survey. It'll be Thursday morning, our time. We've also got your highs and fires, so your JOLTS job openings and your Challenger job cuts, along with your FOMC statement and press conference there as well. So we'll see what they're going to do. 25 basis points is the expected increase. You can see here from 4.5 to 4.75%. And anything outside of that, above or below markets, are going to swing, make no mistake. Then we've got the ECB policy meeting as well. What a massive week. Look at all those reds. I don't think I've ever seen a week with as many reds in it as this one. And then to cap it off, just non-farm payrolls on the Friday. Absolutely massive week, and it could be chaos. A quick mention here for Ask the Experts. I will be kicking that back off next week just for the live streaming at this stage, because I haven't got this page working yet. So disregard that link. It's not working as yet. We've had to make a few technical changes here and adjustments, but certainly come and join me on any of those usual streaming platforms that you caught me on last week. And the regular sessions will be back very, very soon. Apart from that, if you're not a client of ThinkMarkets, you really should be, because we are the good guys on the Australian broking scene. Everything you need to trade in terms of shares, ETFs, $8 flat rate per trade, and we are CHESS sponsored. There might be a cheaper rate out there if you really look for it, but I guarantee they won't be a CHESS sponsored rate. So we are the best there for you owning your shares, and that is super important, especially if you've got a self-managed super fund. Hey, if you're looking to trade CFDs, we've got all the key markets you wish to trade, including that high-grade copper contract. I think you should take a look at FX, indices, commodities, futures, crypto, and shares. Of course, market leading spreads and commission free on shares, whether it be Aussie or US shares. We are an award-winning broker. We keep winning them. We didn't just win one 10 years ago. We keep winning won a couple late 2022. Easy to use multi-asset platform, world-class trading apps, dedicated account manager with 24/7 customer support. I do shadow shop various brokers from time to time, and I had one that didn't get back to me for a whole week. Can you believe that? Didn't get back to a request for support for a whole week. Hey, you can call us and speak to somebody immediately. If you are watching me on YouTube or any of the other streaming channels, make sure you hit the subscribe button to stay notified of all of my future updates. And please hit the like button to let me know you like what I'm doing, so I continue to do more of it. Apart from that, it has been a pleasure chatting with you today. Hopefully you got lots out of the presentation. All the best for your investing and trading. We'll catch up again. Bye-bye for now.